What's up, guys? Eric here. Something's got me all fired up this morning, and I had to make a video to talk about this. And you're going to want to watch this. I'm pretty sure I'm going to save a few people, hopefully a ton of people, for making some really big mistakes with your investing journey, your investing career. Now, there was a tweet this morning essentially saying young investors should invest in dividend growth companies, not risky growth stocks. Now, here's the thing, guys. Depending on how you interpret that, there could be some truth to it, but this video today is going to break that down and explain the difference really between growth and dividend growth investing and how I would play it, how I did play it when I was young. Here's the thing, guys. When you're younger, you have the ability to take more risks because you have more time. Now, compounding is the eighth wonder of the world, and dividend stocks are excellent. I use them as part of my portfolio creations. So I have different buckets and different pillars. And if you're not familiar with the channel, you can check out some previous playlists. But essentially, using a combination of ETFs, dividend stocks, growth stocks, and even some spec stocks, and really adjusting that to your risk tolerance as well as your age. The younger you are, the more risk that you probably can take. When I was young, I made the mistake. When I first started, I went too risky. I invested, my first stock ever I invested in was a biotech stock in the late 1990s. At the time, it was $2,000, which doesn't seem like a lot of money now, but back then, my rent was $110 or something a month. So I was taking almost 2 years, 18 months of my rent, throwing in one stock that I didn't know anything about. It was highly speculative. I didn't do my due diligence or research. It was a spec stock, and it went to zero. That was my first investing decision, and I learned the hard way. So then I shifted and said, well, that's too risky. I'm going to buy the safest stocks I can. So, things like you think of AT&T, Kraft Heinz, we're going to look at a few of those today. And those might have dividend growth investing. I'm going to show you the definition of dividend growth investing because I think people confuse it. They assume that dividend growth, the growth part, means it's a growth stock with a dividend, but that's actually not true. So what you really would want is what we call in Fired Up Wealth, DGIF, or dividend growth investing for FIRED, and that's going to give you total growth, which is going to give you growth on the dividend and the share price. But I'm going to show you some examples in this video, some comparisons to different growth stocks over the past decade versus some of those high-quality dividend growth stocks to show you just the exact returns of what you got from each and explain the process that I think is best. Now, at the end of the day, I'm going to say this, guys. I'm not a financial advisor. This is to help you make your own decisions. And at the end of the day, every person has a different risk tolerance and suitability. So you might be very risk adverse, and you might be in your 20s, and you might be a dividend growth investor. There's nothing wrong with that. But this video is going to really, hopefully, educate some people on what each of these definitions means, what type of stocks they are, so that you can identify them correctly and build a proper portfolio for your age and for your risk tolerance and for your suitability. I guarantee you're going to learn something from this video, and I hope that you stay tuned for the entirety. Okay, let's jump right into this. So 10 dividend growth stocks that are popular on Robinhood. So dividend growth stocks right here, guys, are categorized as companies that have consistently raised their dividend payouts over the years, but the companies still reinvest part of the cash in the business for growth and expansion opportunities. I mean, pretty much every company, hopefully, invests something back into the business. What I want you to focus on here, if you talk about an OG DGI investor, dividend growth investing, they're focused on the growth of the dividend, and that's their primary focus. And generally, you're using that strategy as an income strategy to generate passive income off dividends to retire off of. And you're hoping that that dividend actually outpaces inflation. So that dividend grows enough to outpace inflation. That's what you're doing as a dividend growth investor. And that's the end game of Fired Up Wealth. So I've got a plan for 2030 where my portfolio, I call it metamorphosis. It metamorphosizes into a beautiful butterfly in 2030 where it's going to pay me around $200,000 a year in passive income and dividends. That's what I'm building. And that's the journey you can follow on the channel. So definitely subscribe if you're interested in this, because we're talking about how we can use a balanced portfolio that includes growth stocks, not all growth stocks, not all spec stocks, not meme stocks, managing your risk based on, again, your risk tolerance, and then slowly changing that portfolio as you age because your risk tolerance will change. And as you get older, you want to preserve some of that capital. But the idea behind this is if you invest in some growth when you're young, you can take those risks. You're going to build wealth faster. It doesn't mean YOLO investing into meme stocks thinking you're going to get rich overnight. That's not it at all. It's just a better return over maybe a 10-year period, and then taking those profits, converting them into these blue chip dividend stocks. Okay, so if you've seen my masterclass series, you've seen these next slides, but it'll be a good recap for you. And for anybody that's new to the channel, this will be a great way to understand the different types of stocks so we know what we're talking about here. If you have not watched the masterclass series, there's 11.5 hours of videos. There's 12 videos. Goes from everything to how to invest to options trading, investing from A to Z, everything I've learned in 20 plus years of investing. You can check that out on Patreon, Fired Up Wealth. You can go Google Patreon, Fired Up Wealth. So what kind of stocks are there? Growth stocks. They have earnings growing at a faster rate than the market average. They rarely pay dividends, and investors buy them in hopes of capital appreciation. So a startup technology company is likely to be a growth stock. Now, it's important to understand that there's different levels of growth stocks, and there's also something we call a spec stock that we'll get to later. Now, growth stocks I rank them, there's actually 3 different levels of growth stocks. You think of hyper growth, you think of fast growth, and you think of mature growth. So Amazon would be what I consider a mature growth stock, and you have to understand the difference. A lot of people just categorize growth stocks as they're all equal, and they're definitely not all equal. There's different types of growth stocks. For example, SaaS and cloud, there's different ways to evaluate those stocks, and it's important to understand the difference. So income stocks, they pay dividends consistently. Generally, if it's like 4% yield or higher, you think of utilities or REITs. That's what I would call an income stock. And generally it's investors buying them for income. So you're retired and you want a higher yield, so you're using these to generate that income to increase your dividend yield. Value stocks are interesting because they're generally low PE ratio stocks or stocks that have been beaten down where investors think that they're an opportunity. So you hear value investing. So value stocks may be growth or income stocks, can be any kind of stock where their PE ratio may reflect that they've fallen out of favor. So they might be out of fashion, and they could even be cyclicals, and value investors are looking to buy these value stocks and hope that the market overreacted and that the stock price will rebound. So that's what a value investor is focused on. Blue chip stocks are shares in large, well-known companies with a solid history of growth, and these generally do pay a dividend. So what kind of stocks are there? Kind of continued. Let's look at some examples. Growth stocks, Amazon, Facebook, CrowdStrike. Now this was made probably almost 2 years ago, 18 months ago, this slide deck. Facebook, of course, has fallen out of favor, but you look at Amazon, that would be more mature growth. You think of CrowdStrike, you know, that's somewhere in between hyper growth and kind of normalized growth at this point in my ranking system. So growth stocks, give you an example there. Income stocks, AT&T at the time. Now, since I've done this slide deck, AT&T has cut their dividend, but you think of like Altria, you think of NWE, which is a utility. Those are income stocks. You generally hold an income stock. The main purpose is for the income, for the dividend that you get from the stock, and you're generally not getting a lot of stock price appreciation. So the stock price is not really going up a lot, and you don't care that much about that. You're focused mostly on the income. Value stocks at the time of this, you know, would have been like Cisco, Kroger, Viacom, where you think they're really beat down, you know, low PE. And that might have changed since I did the slide deck, but to give you an idea, blue chip stocks, you think of like Johnson & Johnson, McDonald's, GIS, which is going to be General Mills. So fired up methodology. So I've been investing almost 25 years, and I've created a system that I call Fired Up Wealth. So FIRED stands for financial independence, retire early with dividends. And even if you aren't trying to retire early with dividends, the channel will be very helpful on your investing journey because I learned a lot and I made a lot of mistakes over my 20 plus years of investing. And this channel is here to help you try to avoid some of those mistakes. So growth stocks we talked about. It's important to remember there's different types of growth stocks. Not all growth stocks are created equal. And spec stocks are not the same as growth stocks. A spec stock, the best way I can sum it up in as short as possible is it's mostly a story. There's 2 types of analysis that we talk about in the masterclass, quantitative and qualitative. And when you think of a spec stock, it's really going to be that qualitative analysis where it's a story. You just believe that this stock could be big someday. You can think of like some of the legalized marijuana stocks, or you can think of some of the space type stocks, you know, where they don't really have a whole lot of fundamentals, but they have a really strong story, and you're investing in those hoping that they'll be worth more someday. And you have to be careful with those, because those are the kind of stocks that can give you 10-bagger returns, or they could literally go to zero. And this is where people get in trouble, is they build an entire portfolio off spec stocks trying to shoot for the moon, YOLO Lamborghinis. And this is where I think, like on Twitter, when this person said, you know, invest in dividend stocks, not growth stocks, they're thinking of more of the spec stocks. And it's important as an investor to understand the difference, because there's a huge difference. The more risk, the more reward. And you have to be careful with having too much risk in your portfolio with too many spec stocks or hyper growth stocks. Income stocks, we talked about. Dividend growth investing, again, guys, this is focused on the growth of the dividend. So a lot of people see dividend growth investing, they think it's a growth stock that pays a dividend. No, dividend growth investing, DGI, the focus is growth of the dividend. You also want to have some share appreciation, but the main focus, if you talk to a DGI investor, they're generally using this in retirement, and they really want that dividend to increase each year to outpace inflation, and that is the focus of DGI. When you think of dividend growth investing for FIRED, what we call DGIF, now that takes it to the next level and identifies stocks that have total growth. So growth of the dividend plus growth of the actual share price. And you can do that with 5 criteria. So number 1, you want to have a lower dividend, 3% dividend or less in most cases, because you want money for the business to invest in the business, to grow the business. We want growth. Kind of tying off of that dividend payout ratio, you want to have it 50% or less. If the dividend payout ratio is too high, there's not enough money for the business to invest in growth. You want 5 years of dividend growth or more, and with that, you want at least 10% growth in that dividend over a 5-year period. And you also want 10-year annualized growth returns, 10% or more on the actual share price. Of course, the more growth on the share price, the better, and the more dividend growth, the better. You have to be really careful with the dividend being too high. A lot of the best DGIF stocks pay maybe less than 1% dividend, but you're still using that compounding. And those stocks can grow from DGIF to DGI to income and really grow with your portfolio as your portfolio kind of metamorphosizes into your end game, or your butterfly, as I like to call it. So this article, guys, is talking about Starbucks, Pepsi, and Walmart as some of the favorite stocks that are dividend growth stocks that are popular on Robinhood with younger investors. Now, there's nothing wrong with those companies, and they'd be good stocks to have in a balanced portfolio. But I think that if you're new to investing, especially, you might see some of this stuff, especially right now. The market is crazy. You know, everybody has the worst sentiment possible on growth stocks. So if you're new to investing, you might get this idea like, I should just go buy Walmart and avoid growth stocks altogether. And that could be true. Again, every person's going to be different, but hopefully you learned something from this video to realize that that's not always the case. So what might happen is a young investor will read some of this or see the tweet that I saw that said, young investors should invest in dividend stocks, not growth stocks, and go build a portfolio with Starbucks, Pepsi, Walmart. There's nothing wrong with that. They're high quality companies. But let's just look at some comparisons when you think of returns and just see what the opportunity costs would have been over the past decade or so. One of the first stocks that come to mind, guys, is AT&T. Now, AT&T would have been classified for a while as an income stock, but the dividend's been cut. But this was really a dividend growth darling for a long time. And if you joined any kind of dividend growth investing group, these are the kind of stocks that were pushed all the time over and over again. Okay, so this blue line up here, this is Amazon. This gray line down here is AT&T. So on a 10-year period, if you compare the two, Amazon's up 1,159%. AT&T would have lost you 21.45%. Now you got paid a dividend the whole time, even though the dividend got cut, you know, it's lower now. You got paid a great dividend, and you were reinvesting the dividends, and you were compounding. You're down on the stock. And I actually owned this stock for a long time myself. You'd actually have negative returns. And of course, guys, I know some of you are going to get upset because you're going to say, oh, you're using bad stocks to compare it. I'm going to use the stocks next. I'm going to use Pepsi, Walmart, and I'm going to use Starbucks, which are specifically pointed out in that article we just looked at. And I'm going to show you comparisons on those. Here's the thing, guys. If you look at this, we'll look at Kraft Heinz too. Kraft Heinz. Here's Kraft Heinz in gray. Here's Google in blue. So in the last 10 years, Google would have given you, even after the drop, 747% return. Kraft Heinz, negative 3.56%. This is the danger of a young investor investing in the wrong dividend stocks when they don't understand what dividend growth investing really means. Because Kraft Heinz would have been another one for a long time. It would have been one of the top DGI picks, you know? So let's go and look at some of these other stocks. Before I do that, I want to look at Coca-Cola. So Coca-Cola, here's the same kind of deal. Now, what's really interesting about this one is I'm going to compare Coca-Cola to SPY, so the S&P 500. So the S&P 500 over the past 10 years is up 225%. Coca-Cola, which would be a dividend growth darling, and there's nothing wrong with Coca-Cola. It pays a nice dividend. Warren Buffett owns tons of it. In the last 10 years, it gave you a 76% return. Not a bad return by any means, but the S&P 500 crushed it. Why? Because it has some of those growth stocks in it. It has technology in that basket. So my argument is if you're trying to be passive and avoid risk, instead of trying to pick individual stocks, which if you don't know the difference of this stuff in the first place, you probably don't have the ability to be a good stock picker, don't have the time, I would say buy an S&P 500 index fund, like the VU probably, if you're a long-term investor, that's the Vanguard version of SPY. Buy that S&P 500 index fund and Netflix and chill, because it's probably going to outpace most dividend growth baskets, and you can always convert that to yield later. If you're working, you don't necessarily need passive income off dividends. There's nothing wrong with having some of it, but I would argue that if you're going to be an individual picker and you're going to try to pick dividend growth stocks, dividend growth investing DGI stocks, you might be better off just buying an index fund. And if not, you might want to, look at a Fired Up Wealth methodology where we're using a balance of growth, dividend stocks, spec, and so on. So let's look specifically at what they talked about in the article. So Starbucks was one, and I'm going to use the comparison of QQQ. So you could have bought just the QQQ. And this is over 10 years, so I understand that it could be different the next 10 years, but just showing the opportunity cost here. So if you were a young investor 10 years ago, and you would have bought Starbucks, you'd be up 184%. That's not a bad return at all. But you could have just bought the QQQ and actually over doubled that and gotten a 431% return. How about Pepsi? Pepsi's another one. Now I'm going to compare CrowdStrike, and I'm going to just use 3 years because CrowdStrike was a newer IPO, I think in 2019. So if you would have bought CrowdStrike as maybe a spec stock, if you didn't know what it was, you would have had a 235% return, 234% return. And Pepsi would have given you a 36% return. Yeah, Pepsi's definitely the safer pick. But if I would have bought CrowdStrike, I could have sold it up here when it was up 300%. I could have taken my profits and I could have rolled it into Pepsi. Doesn't that seem like a much better approach than just, I'm 20 years old and I'm going to buy these boring stocks that give me under average returns? In my opinion, the answer is yes. Let's look at Walmart. That's another favorite on that list. So here's what are we looking at here? This is going to be Netflix. Now, Netflix just fell off a cliff. Netflix was up here. It was up 7,497%, and it dropped off a cliff, and it's way down here. Well, guess what? Even if you bought Netflix 10 years ago, of course, timing is everything. If you would have bought it at the top, you're in a lot of pain. But if you're just looking at 10 years ago and you had the decision to buy Walmart or to buy Netflix, Netflix, you'd be up 2,216%. Walmart, you'd be up 138%. So this can be really powerful, and it can make it really hard for young investors to ever cross the finish line. Now, some people that are saying, hey, invest in dividend growth stocks, maybe you have you're going to retire at 65. Well, maybe that's true then if you don't want to worry about the risk. But I still would argue that you're better off with an index fund. I really believe that. So if you're going to take some risk and try to outperform the market, and you say, well, that's not easy to do, growth stocks are punished. Peter Lynch is a value investor. He wasn't investing in hyper growth stocks, but his philosophy rings true for any investor. He was trying to be right 6 out of 10 times. Now, if you're right 6 out of 10 times on hyper growth, you're going to grossly outperform the market. And if you're young, you can afford to take those risks. You can outperform the market, sell, trim, take some profits, and reinvest into some of these dividend stocks. I had a platinum call yesterday with one of the Patreon members, and he had a portfolio he shared with me on Zoom, and it was awesome. He showed me how he was selling stocks November and December. He was trimming them, like some of his favorite stocks like CrowdStrike and some other growth stocks, taking those profits and buying some of these we call DGIF stocks. Now, as a young investor, if you are going to invest in dividend stocks, and that's your risk tolerance, I would encourage you to look at what we call dividend growth investing for Fired. And the reason we categorize it differently is DGI is a very broad term that can include a lot of really bad companies. DGIF really targets the best dividend stocks that also have growth. So you're talking about total growth of the actual stock, the appreciation of the share price, plus growth of the dividend. But you have a very small payout ratio, and you have the ability to reinvest in the business and to grow it. And I've got a whole playlist on the channel that breaks down. A couple years ago, I did my favorite top 60 DGIF stocks, dividend growth investing for FIRED. So I encourage you to go check that out. Subscribe to the channel. Go check out some of those older videos. And when we build out portfolios, we're using those different buckets. We're using growth. So if you have an extremely low risk tolerance, maybe you have only 10% growth stocks or 20%, but you build a portfolio that makes sense for you. But to avoid growth stocks altogether, guys, I think that that's a dangerous game to play. It's a travesty. And I believe you can be a stock picker with a little bit of time, a little bit of effort, and a little bit of research. And if that's not something that you want to do, I honestly think you're better off just buying ETFs. So go buy an S&P 500 index fund. And yeah, you might get a little bit less dividend yield, but again, you don't necessarily need tons of dividends if you're going to retire at 65 anyway. So those are my 2 cents on this, guys. Growth stocks versus dividend stocks. Please subscribe. Please click the like button. Drop me a comment. Appreciate your time and attention. Have a great day. Take care.